Hello, my name is Philip Totaro. I'm the founder and CEO of market research firm IntelStor. Welcome to your weekly dose of truth to power. Truth to Power examines data driven insights for the energy sector with a focus on renewables. On this week's episode, we'll look at some of the recent renewable energy asset sales offerings by BP and EDF. We'll look at the profitability of those portfolios and what they offer to the acquirer. Last week, there was some big news regarding two major renewable energy asset owners who are putting some or all of their portfolios up for sale or opening up to investment. Specifically, oil and gas company BP sold off their entire onshore wind energy asset portfolio to LS Power in the USA, and Électricité de France put their Americas assets up for sale, including the US, Canada, and Brazil. So I thought we should take a look at these asset portfolios and understand how acquirers or investors will extract value. Let's start with the BP portfolio. BP said that the deal comprises 10 operating wind farms with a combined gross generating capacity of 1.7 gigawatts. LS Power will add this to their operating fleet, which now crosses 4.3 gigawatts of renewables, inclusive of the BP assets. BP first developed this wind farm portfolio back in 2008, but they've come under criticism from investors for its underperformance in recent months. This has led them to develop a new strategy in which the proceeds of this deal will help to cut debt, increase their cash flow as they pivot back to oil and gas, and contemplate a possible merger for their entire company. The 10 wind farms have a mix of mostly GE Vernova turbines, but Fowler Ridge in Indiana has Vestas, and they also still have some of the last operational Clipper wind turbines in the USA, in California, and South Dakota. The asset portfolio is between 13 and 18 years old, with an opportunity to repower the projects which have not already been. Flat Ridge, also in Indiana, already repowered some Clipper turbines with Vestas V110s. Since 2008, these projects have generated more than 5.5 billion in revenue, including just over 1 billion in production tax credit revenue. All the assets have broken even except for the Fowler Ridge Phase 2. All of these wind farms cost just under $33 million annually to maintain, with an average cost of maintenance of $6.32 per megawatt hour produced. That's basically right around the overall market average. Besides the repowering potential for the portfolio, the real attraction for LS Power is the net profit to the planned end of asset life. That totals more than 2.6 billion, or just over 1.4 million per installed megawatt. With the changes to the PTCs in the tax and budget bill, along with likely changes to start of construction to qualify for those PTCs, which I reviewed last week on the show, LS Power will need to repower the rest of the portfolio sooner rather than later to take advantage of the gap that exists in the start of construction rules, which presumably will be changed by the end of the year. Now, EDF is also looking to raise some capital to invest in the refurbishment of nuclear power plants in France. So they're going to offer up their asset portfolio throughout the Americas, hoping to raise at least 2 billion euros. Amongst their wind energy assets, they have more than 7.6 gigawatts installed throughout the USA, Canada, and Brazil. Of that, just under 3 gigawatts is what they still own outright, and it would comprise the portfolio they would offer to a prospective investor. Their portfolio includes some of the most lucrative PPAs in the United States, with the Pacific Winds and Shiloh projects in California. And for projects which are US based, the majority of them span the range from 3 years old to 13, with only the Fenton project and the second phase of the Shiloh project being a bit older. They've generated a total of 3.3 billion in total revenue since they started operating these wind farms, including just under 600 million in production tax credit revenue for the US-based assets. 92% of the revenue in the portfolio comes from their assets in the United States, with the rest coming from Canada and Brazil. Now, inclusive of their assets in all three countries, they're spending over 42.4 million per year in maintenance costs. Their average O&M cost per megawatt hour produced is only $5.22 a megawatt hour, which is actually well below the industry average, but that's accounting for the fact that they have a relatively young portfolio and they also have a very hands-on internal maintenance team. Their portfolio will generate a total net profit to the planned end of asset life of more than $2.6 billion, which is over 1.8 million per megawatt installed. And thus far, only the Rock Falls project, which was installed in 2017 in Oklahoma, seems like it will be very tight on turning a profit during the planned lifetime. But all other projects across the whole portfolio are poised to break even during their planned asset life. Given many of these factors, their 2 billion euro asking price actually seems quite fairly valued for investors, according to IntelStor's analysis. Thank you for joining me this week. I'm Philip Totaro, and this has been your weekly dose of truth to power. Follow us on IntelStor's YouTube channel as well as your favorite audio platforms. And visit www.intelstore.com to join more than 200,000 subscribers to our renewable energy data solutions. A full analysis of any asset owner portfolio, plus how you can use IntelStor to pre-screen renewable energy asset M&A deals, is available to subscribers. And if you haven't already done so, register today for the next Wind Summit event in Houston, Texas this October. Visit www.windsummit.org and join hundreds of your industry colleagues from companies like NextEra, EDPR, EDF, Pattern Energy, Clearway, Apex Clean Energy, and more. We hope to see you there.